that should be, I think that should be okay for our session today. And I'm going to start right now. I thank you, Afif, Jali, and team for arranging our session today. And thank you everyone for taking some time to join our session today as well. So just so that you know, yeah. Just so that you know, for the Structured Warrant Educational Series, we would usually go from the beginner session to intermediate session, and then we also do case study as well every now and then. This is the usual circle for our Structured Warrant Educational Series. And in order to be able to spread, this is because it'll be better for us to be able to spread more information on structured warrants to a wide range of investors. But given that we have already gone through a few rounds of this beginner, intermediate, and then also case studies, we're also planning to add a new session with a new topic to the mix soon. So watch out for that if you're interested. Yeah. Okay. Today we are going to mainly talk about how would you go about choosing the right warrants for you. So if you have any questions, you can post them in the Q&A section, and then I'll get to them whenever I can. All right, this slide especially will be sent to your email later on after the end of the session if you are interested to look at the slides on your own time. All right, let's start today with a little recap of what we've discussed in the beginner session about more than a month ago. So it's been a while since the beginner session. Maybe a quick refresh will help everybody to understand where we are right now as compared to what was discussed in the beginner session. All right, the first thing that we discussed in the beginner session was that the type of warrants available in the market. I'm sure you guys are well aware of the type of warrants that are available in the market right now. You have two warrants. You have two types of warrants. You have structured warrants and you have company warrants. And structured warrants is further broken down into call warrants and also put warrants as well. Okay, the second thing that we discussed in the beginner session is the reason to invest in structured warrants. There are quite a number of reasons, but the main reasons that investors usually get into structured warrant is mainly because of the leverage impact that structured warrant gives you. Structured warrant can amplify your returns. That's the first one. And the second one is the lower capital requirement for investing via structured warrants. All right, because structured warrants is a portion of the price of the underlying mother share. So the amount of capital that you need to put up is a lot lower as compared to if you're buying the mother share directly. And because of the lower capital outlay, your potential loss is also limited to that smaller amount as compared to buying the shares in the market directly. All right, and the last one popular reason why people use structured warrant in their investment strategy is because of the share replacement strategy. Specifically, you can use structured warrants if you have a position on a certain share, certain underlying, and then you want to use that capital, you want to sell off that share, but still maintain some exposure to that share. You can instead sell off that share, that mother share, for example, Axiata, sell off the Axiata shares and buy Axiata warrant at a lot lower capital requirement. And then you'll still get exposure to that Axiata mother share. All right, that was the second thing that we discussed in the beginner session. The third one, we've also taken a look, took a look at all the calculations required for you to calculate your settlement amount at maturity. Let's say if you hold those warrants that you've bought until maturity, and then you want to find out what kind of settlement that you've already gotten. We've already discussed the calculation required for you to get the numbers, the settlement amount that is going to be due to you. All right. And the fourth thing is, which is also pretty important that we've discussed in the beginner session, is the time value and time decay. This is one of the impact of the tenure of the warrant, because the tenure of the warrant is one of the value that is incorporated into the price of the warrant. So as the time value declines, the tenure of the warrant declines, the value of that time value is decayed over time, and then that will reflect in the lower price of your warrant as well. Okay, the last thing that we discussed in the beginner session are the factors that affect the value of warrant. We have dividend, interest rate, tenure, volatility, share price, and also exercise price as well that we've discussed that affects the value of structured warrants. So for those who missed those, please let us know if you like. You'll be interested for us to repeat those sessions, and if not, we can also share the slides that we've used for the beginner session to you as well. You can reach out to your dealer, and then we will share the information accordingly. All right, now getting into the topic today, choosing the right warrants. Okay, all right. There are many ways to go about this in picking the right warrant that fit your investment purposes. But we've already made some arrangement and we've codified and arranged systematically one of the ways that for you to do it in these 6 coming steps. All right, you can use this maybe as a guide or even modify this step to suit your own strategy. Okay, let me point you to the first step over here, which is picking the right stock. Well, this is a very important point to bring up. Even though you're just buying a warrant, which is separate from the mother shares, but this warrant is a reflection of the performance of the mother share. So it's still important for you to do your due diligence on the mother share and make sure that the company that you're buying into have some reasonable ground for you to get into the exposure of the underlying shares. All right. And the second one is, second step is establishing your investment style and investment horizon. Okay, there are a lot of investment style available in the market. Either be it you want to invest based on the information in the news that is available on the company, or the potential tender that the company is likely to win in the future. You can also look at the earnings that is going to come up soon. Those are the few and many others also available type and style of investment that you can actually use for your strategy. So after you've done that, you also need to determine the time period of your investment as well, the time horizon, how long you want to be in that particular position. Let's say if you bought a Axiata warrant, for example, in anticipation that the earnings report in the next couple of months will be a positive one, and then you're expecting the warrant prices also to go up. So your tenure, your investment horizon would also be within that range, 2 to 3 months maybe, for example. All right. The third step is knowing your risk appetite. Okay, in order to know your risk appetite, you need to find out what are the available warrants available in the market, and then you need to also learn about what each of those warrant, the risk status of those warrants. The risk level of those warrants will be dependent on the characteristics of those warrants as well. We'll get into this more in later slides. All right. Once you've done step 1 to step 3, the next one is, of course, you want to find out what is the available warrants. What are your options in the market? What are the available warrants for you to buy? All right. Then you learn all the warrants. Let's say for you're interested in Axiata. I keep using Axiata in this example because it's something that just popped out in my mind. So you can use, let's say, Axiata, and you find out there's a bunch of warrants on Axiata in the market. And then what you'll need to do then, you need to take a look at each of those warrants and find out which of those is suitable to your risk investment, your risk profile, your investment strategy, and so on. All right. Once you've done that, you learn the available warrants in the market. Of course, you need to compare those warrants among themselves and find out which one is suitable for you. And then you can conclude and finally make your decision. All right. Okay. Those are the 5 steps for you to, in order for you to be able to pick the right warrants. The 6th one is somewhat subjective. This is because you need to also know who is the issuer of the warrant. All right. Because each warrant, structured warrant that is available in the market has an issuer behind the scene who's handling the market making, who's handling your settlement, and also will be settling your investments as well in the case that you have some gain on your warrant or and whatnot. So it's important to know for you to know who's the issuer of the underlying the issue of the warrant. so that you can be certain that the issuer warrant is financially stable, a reputable issuer, so that you won't have any problem when it comes to a point that you need the issuer to settle your investment. You're buying this warrant with the issuer, and the issuer eventually, in the case, when the case may be, they need to settle the warrant that you've bought with them. So this issuer needs to be a financially stable issuer and also a reputable issuer. Okay, now let's get right into the first step of the 6 steps overview that we've taken a look at just now. All right, the first one is picking the right stock. Of course, there's quite a number of methods that you can go about in picking the right stock. And this decision is, I would say, is actually quite similar to making any other decision. It ultimately comes down to the merit of the stock. All right, and then if you want to evaluate the merit of the stock, there's a few ways that you can do it. And one of the popular ways in the market is fundamental analysis. You can see over here, which involve analyzing the company's financial statement. You have analyzing company's financial statement, which involves the cash flow statement, balance sheet. You have profit P&L statement, and all the other annual report details that you need to take a look at. All right, that's one of the ways that you can evaluate the merit of the company through fundamental analysis. And also, you can also couple that with technical analysis as well. Technical analysis is basically the study of, I wouldn't say this is the right definition of technical analysis, but this is what the market is saying about technical analysis. Is basically a sort of representation of the market sentiment towards the underlying shares. You can see from the movement of the share price what kind of market participation is currently happening in the market for that particular underlying. That is what you can get from studying technical analysis. You can study, you can learn if the share is being overbought or is it being oversold. And then you can see where the range of prices in between a certain range, and then you can take advantage of that. So this is one of the ways that you can, a few ways that you can actually decide on the right stock for you. All right, in case you are interested to learn more about either fundamental analysis or technical analysis, we have also separate sessions for each of these that is being done by Maybank Investment Bank as well. You have technical analysis on every Tuesday, and also we do fundamental analysis as well. Fundamental analysis is by our head of in-house retail research, T, and then we have technical analysis in-house expert as well, named Ihsan. So if you guys are interested to learn more about fundamental analysis and technical analysis, you can stay tuned and find out about when that session might be in the future. All right, that one is the first step of picking the right warrant. Second one, you have, like I mentioned just now, you need to establish your investment style and investment horizon. All right, this is basically about asking the question, what kind of situation or information will have impact on your investment decision, and when to get in and when to get out. All right, there are a lot of names of the type of investors if you Google it via the internet, via the web. So basically, these are a few of them. All right, the first one is being called the day trader. I think the name gave out the meaning already. This is where the investor aim to make a gain by getting in and out of any stock within a period of a day. All right, this is what you call day trader. And then the next one, some of you are probably familiar with this is the trend follower. This is the kind of sentiment-based investor looking to ride on the market momentum. The most obvious example for this one would be the Top Glove scenario last year, at the start of the COVID pandemic, where the demand of the glove is expected to rise significantly. And then investors can already see that the share price is gradually moving up. So this kind of investor will take notice of those trends and take advantage of the momentum going up. All right. And this type of investor will usually look to be invested for a medium term or so. All right. And then you have high roller, you might call it. This is a little bit of a gaming term because this kind of investors involve taking big risks based on speculative information or the data that they learn all over the internet, and then they try to make their own judgment about the company. And this is a bit of a high risk type of trading as well. So, okay, the next one is called contrarian investing. This is the kind of investors that, for example, who will purchase warrant while the price is on the way down in anticipation of a rebound. Okay, so you have 4 types of investors, investment style that we can show to you right here. So this is not an exhaustive list, and your style is not necessarily just one of this. Your investment style could also be a combination of this as well. Okay, now before we move on to step number 3, there are a couple of terms that I'm going to elaborate to help us understand the next steps better. Steps 3. Before we move on to step 3, I'll need to clarify a few terms with you guys first so that we can better understand step 3 and onwards. All right, the first one would be delta. All right. Delta is just basically a Greek mathematical sign. It can mean different thing in different contexts. But here in this derivative structured warrant context, it simply means how much a warrant price is expected to move due to the price movement of the underlying stock. So this will definitely be a lot easier to understand through an example. So I'm going to point out to you to the red box over here so that you can take a look at the example. The example is very direct. It says that if a call warrant has a delta of 0.5 or 50% basically, it simply means that the warrant price should theoretically move by 1 cent for every 2 cent movement in the underlying share. Underlying share moved by 2 cents, and because the delta is 50% over here, the warrant price should theoretically move by 1 cent. All right, this is the concept of delta. It's pretty straightforward for you to understand, I believe. And this is the formula for delta over here. But just to let you know, actually, you don't have to calculate this yourself because all this information delta is already readily available in the market. You can just type in the name of the warrant that you want to look at, and then you can see already the delta and all other information about the warrants. You don't have to calculate this yourself. This is just for your knowledge, side knowledge as well. All right. So basically, another thing to note, the level of delta can also be an indicator of the likelihood of any warrant being in the money, at the money, or out of the money. We'll get into the terms of moneyness, which is in the money, at the money, or out of money shortly in the next slide. Okay, the higher the delta is, the more the warrant is expected to mature in the money, which will be relatable in the next couple of slides. Okay, let's move on to the next slide. The second term that you guys need to be familiarized with before we move on to the third step is warrant sensitivity. This one we've already discussed in the in the beginner session. We've already touched a little bit on this one. Basically, what warrant sensitivity does is it's another way of measuring the relationship between the movement of the share price and the warrant price. Okay, again, it will be easier to look at this and understand this through an example. Let me bring you to the table here. Bring your attention to this table over here. You can see there is 2 types of warrant, called warrant A over here, and then you have call warrant B. Okay, 2 types of warrant. And this is the mother share price of the warrant. For warrant A is 3 ringgit and 20 cents, and for call warrant B, the mother share price is 80.5 cents. Okay, before we move on, let me just clarify to you how tick sizes works for different price category of the mother share. For the mother share, that the price is above 1 ringgit, the tick size is 1 cent. Okay, so if this warrant is to move up, it's moving up. If the underlying share price is moving up, it's moving up by 1 cent each time. So it will be 321, 322, 323, and so on and so forth. All right. For mother share that the price is below 1 ringgit, in this case is 80.5 cents. The tick size is 0.5 cent over here. You can see. So the mother share in this case 80.5 cents will move up from 80.5 cents to 81 cents to 81.5 cents to 82 cents, and so on and so forth. This is what we mean by tick size for different price category of the underlying mother share. All right. Okay. So sensitivity is basically measured in this. You can take a look at the last row of this example in this table. You can see sensitivity ticks at 5. All right. When we say the sensitivity ticks is 5, it takes the share price to move by 5 tick for a call warrant to move 1 tick. All right. So in order for the relationship between the movement of the mother share and the warrant is 5 tick in the example. So the mother share needs to move by 5 tick, which is 1 cent to 5 cents to 3 ringgit and 25 cents, in order for the warrant price to move from 10.5 cents to 11 cents. Okay. All right. This is what we mean by sensitivity. We've already gone through this in the beginner session, so I won't dwell too much on it. I hope you guys will be able to get the idea of how warrant sensitivity work. And this is the second example. It's the same over here. You can see the warrant sensitivity is 20, which is a lot higher than the warrant sensitivity of call warrant A. So this one would be deemed less sensitive than warrant A. All right. So call warrant B, because the sensitivity is a lot higher, is less sensitive as compared to call warrant A. Okay. And this again is the formula. If you're interested to know the formula, although this information is available for on the web. Anytime you Google the name of the warrant, you can see all the characteristics, all the features of that particular warrant. Okay. All right. The third one that I want to show to you guys is the characteristic of moneyness. Just now we've already mentioned in the money, out of the money, and at the money. All right. This is basically just the relationship between the share price and the exercise price of the warrant. Okay, let's just stick on our example based on a call warrant. Okay, call warrant only, because it will be easier to focus our mind on one example. Okay, we have call warrant over here. So the first one is in the money call warrant. Okay, basically what this means is that the share price, current share price is higher than the warrant exercise price. Warrant exercise price is over here at this level, and the current share price is at this level. This means that the warrant is in the money. So the current share price is, let's say, 5 ringgit, and the warrant exercise price is, let's say, 4 ringgit. In this case, the warrant is deemed in the money. When the warrant is out of the money, the current share price will be below the warrant exercise price. All right, the current share price will be below the warrant exercise price. Like here, the warrant share price is 4 ringgit, and the current share price, let's say it's 3 ringgit. So in this case, this warrant is an out of the money warrant. Okay, when we say the warrant is at the money, these two price is closer to each other. It could be, let's say, for example, the warrant exercise price is 4 ringgit. The current share price could be 4 ringgit and 1, 4 ringgit and 2, or 3 ringgit and 99. This is what we mean by the moneyness of the warrant being at the money. Okay, so I hope you guys are clear when we say the warrant is in the money. For call warrant, the current price is always higher than the exercise price of the warrant, and vice versa for out of money. And for at the money, the price of the exercise price and the current price is close to each other. Okay, I hope you guys are clear on the call warrant part, the moneyness part. Okay, since we've already learned all the three terms just now, let's take a look at step number 3. Those three concepts will help us to better understand the step number 3, which is about knowing your risk appetite. All right. In order for you to, since you have some sort of an idea of what kind of risk that you're willing to expose yourself to, you also need to know what are the risks being offered by those warrants. What are the risk level of those specific warrants? Like for example, for our initial example just now on Axiata, and then Axiata Malaysia, and then you have a bunch of call warrants on Axiata as well in the market. And then you want to know what are the risk level of each of these warrants. Okay, this quadrant technique over here will be able to give you an idea of the characteristics of a warrant relative to its moneyness and the tenure as well. As you can see here, the moneyness is the axis down here. And then you have the tenure over here. Okay. So I'm not going to go through each of the quadrant. We're going to look at the extreme over here. Okay, let's say you're looking at the blue area in this quadrant, blue area here on this quadrant. This is representative of warrant that is deep in the money and far from maturity. All right, as you can see here, it's deep in the money. The warrant in the blue quadrant is deep in the money, closer to over here. And then it's far from maturity. Okay, this type of warrant will have a high level of delta, and usually they'll have a high level of delta, which is indicative of the likelihood of it ending up in the money. All right, this is how it's relatable to the idea of delta just now. As I mentioned just now, if the delta is high, there's a likelihood of it ending up in the money. So this kind of warrant also comes with a usually comes with a medium level of gearing, which is somewhat representative of a medium level of risk as well. So if you're that kind of investors, these are the characteristics of the warrant that you want to be interested in. And on the other end of the spectrum, the one in the red box over here, it is clear that the warrant in this area is riskier in nature because they are close to maturity. Close to maturity over here, you can see the warrant is very close to maturity. Whenever any warrant that is very close to maturity, you have a lot less time to realize the potential of the warrant. And this is representative of somewhat of a higher risk as compared to other warrants that have more tenure in it. Okay. Okay, another thing to note about a warrant that is close to maturity, the level of sensitivity also will be a lot lower. It will require a lot more movement in the underlying share price to move the warrant price. Okay, these are some of the points that you can look at, and the idea here is basically so that you know how to assign the type of risk level on the warrants that you can see in the market based on the characteristics of those warrants. If those warrants are high risk, they probably have a lower delta, lower sensitivity level. If the warrant is medium risk, probably the warrant characteristic will have higher delta and moderate sensitivity, and so on and so forth. Okay, and this will eventually fit into the type of investment style that you choose for that particular strategy. Okay, now let's move on to step number 4. As we've already gone through step number 1, number 2, and number 3, where you pick your stock, and then you learn your investment style, and then your investment horizon, and then you learn about the risk of the warrant. Now it's time to take a look at the warrants available in the market, and then study the terms. We're going to use a very simple example over here, and you can see this is the example for Axiata, as I mentioned earlier. You can take a look at the two Axiata that we have on the screen right now. Axiata 62, the warrant price is cheaper than Axiata 61 by 2 cents. And you have exercise price of warrant C62, which is lower than 661. Lower exercise price usually would mean you have a better chance of getting a warrant that is in the money, which might be slightly more expensive as compared to the out of money warrant, but you have a more slightly also sensitive warrant as well. And the exercise ratio between these two warrants in this example is the same. And next one is premium. A premium, I think we've already discussed this in the beginner session. Premium is indicative of the cost of the warrant. So if you see the characteristics of the warrant in the market and the premium is lower than the other, naturally that particular warrant would be will be at a better cost as compared to the other warrants that you can see in the market. And next one is the gearing level. All right, this is where you get your amplification effect on your capital. So in this case, Axiata 62 has a better gearing effect as compared to Axiata 61. If you're the kind of person that interested in more leverage, higher amplification on your capital, Axiata 62 would be the option for you. And last thing to note in this example is the maturity between Axiata C62 and Axiata C61. Excuse me. You can see that the tenure the maturity is longer, slightly longer as compared to C61. So this example is meant to give an obvious example, although it is not an apple-to-apple comparison. In this example, it's pretty much clear that Axiata 62 is the cheaper warrant between the two, cheaper alternative between the two. Okay. All right. If you've already gone through this stage and you still have a lot of warrants to compare because you are unable to decide and you need more details to make up your mind and to make your decision. Usually there's a few more features of a warrant that you can use for your decision. Okay. In that case, we need to take a look at a couple more terms that will be able to add valuable information for your decision making. These are the additional characteristics of the warrant as well. The first one is gearing. This one we've already discussed in the beginner session as well. It is actually another way to see the movement relationship between the warrant and the mother share. Just now we've already discussed sensitivity and delta, which is also a measure between the relationship of the warrant and the mother share. Here is another one, which is effective gearing. Okay. Here is the formula if you like to calculate the gearing yourself, although like I said earlier, these days you don't have to. And then in the case that you do, after you've done the calculation using this formula, and then you inputted a number, for example, your gearing is 4.38 and your delta is 60%, for example, you get an effective gearing of 2.63. What this effective gearing means to show to you is that for every movement, every 1% movement of the underlying share, the warrant price will move by 2.63%. All right, you can see here, if the mother share price moves up by 1%, your warrant price will move up by 2.6%. If your warrant effective gearing is 2.63, this will be the case. The mother share goes up by 1%, and then your warrant tends to go up by 2.63% based on the effective gearing of that particular warrant. Okay, the second thing to note before we move on to the last step, number 5, is implied volatility. All right, implied volatility is one of the important factors in determining the value of any warrant. Basically, in simple terms, implied volatility gives somewhat of a projection of what kind of volatility is expected over the price of the mother share in the future. So higher or lower volatility will either increase or decrease the price of the warrant respectively. Let's take a look at this example over here. You can observe the figure in the green box on the right-hand side over here. When the market is expecting more movement on the mother share, it will translate into higher level of implied volatility. And when that happens, the price of the warrant also will reflect on the increase of the implied volatility. So if the market is expecting the movement of the price will be higher in the future, that one will increase the implied volatility. And then implied volatility will then be reflected by the increase in the price of the warrant. And then it works vice versa as well. And so implied volatility is one of the characteristics of the warrant that you can see whenever you search for any warrant in the market. You can see also the level of implied, I'm sorry, that one is not, this is something that is not available in the market right now. I think I'll need to double check on that one. Okay, all right. I hope you guys are able to understand the concept of implied volatility and how it affects the price of the warrant, as I've discussed and explained based on the example over here. Okay, now, since we've already learned the two concepts just now, effective gearing and implied volatility, and delta, we've already learned earlier. Since the step number 4, you have already taken a look at the warrants available in the market, but then you still still not able to make up your mind and make a decision on which warrant to invest in. You can consider a few more characteristics of the warrant that you can take a look at to probably help you better make your decision on which warrant that you can use for your investment strategy. Okay, here we can take a look at the additional feature of the warrant, which is delta. And then you have effective gearing and also implied volatility, which we've learned in the previous couple of slides just now. Okay, all right. In this case, warrant A has the highest delta, which means it's deepest in the money, making it possibly more sensitive to the share price movement. And that's the difference between the 3 warrant, warrant A, warrant B, and warrant C. Warrant A being having the highest delta. Okay, and then warrant A and warrant C basically is tight over effective gearing. It's basically the same over here, you can see. And then the final, hopefully the determining factor that will be able to help you make a decision between these 3 warrants is the implied volatility over here. Because you can see that the warrant A has the lowest implied volatility, which gives you a sort of idea that the warrant gives you the most value out of the 3. Okay. All right. I hope you guys are able to understand some of the concept that we've shared on all the 5 steps that we've gone through just now. And now it's time for us to go to the first frequently asked question. Okay, here's the first one of the first frequently asked questions that we have. Why is the warrant price not moving in tandem with the underlying share price? Because sometimes you see the underlying share price goes up and goes down, but nothing changes on the price of the warrant. So you're wondering, why is this the case? Okay, one of the reasons is because the warrant is deep out of the money and very close to maturity as well. You can take a look at the one on the red box over here. By the way, we are using call warrant in this example. So this is one of the reasons why you see that the mother share price moves up and down, but there's no movement on the warrant, so to speak. This is because the warrant is deep out of the money, which means let's say for call warrant, the share price is way below than the exercise price. Okay, so the warrant is out of the money, way out of the money, and it's not sensitive to the movement of the underlying share. All right, this is the reason why sometimes you see that the underlying share price goes up and down, but nothing happens, nothing changes to the underlying to the warrant itself. So in this case, it takes a lot of increase in the price of the mother share in order for the warrant price to move in tandem. So this is a type of warrant that you want to be careful with. If you have some sort of an idea on how your strategy involves using this kind of warrant, that one will be a different story. But if you don't know the characteristic of the warrant, you might be in a position where you don't want to be buying a warrant that is not sensitive to the movement of the underlying share. So this is the reason why you need to find out about the delta, the sensitivity level of the warrant, the maturity as well, so that you have some gauge, so that you have some gauge on the level of relationship between the movement of the mother share and the warrant itself. Okay, and the next reason why sometimes you see that the underlying share price move, but the warrant price does not move, is because of the eroding time decay. As we've already mentioned in the beginning session, there is every warrant have a time value incorporated into the price of the warrant itself. So whenever you have, as the warrant tenure goes from the start to the end, the warrant time value will also experience time decay, as you can see over here. This is what happened to the value of the warrant as the warrant tenure goes towards maturity. Okay, this example over here goes to show that the composition of the price of the warrant, you have time value over here, and then you have intrinsic value over here. So as we go along towards the maturity of the warrants, and let's say you're 4 months in this example, you can see the time value will deteriorate and you have less overall value of your warrant. And let's say your warrant is 50 cents over here, provided that there is no other changes in the underlying share price. But just because the warrant is moving towards its maturity and has 4 months left to go until maturity, you can see your warrant value probably goes down to, for example, 30 cents. This one is not an actual calculation, it's just to give you an illustration of how the time value can affect the price of your warrant. Okay, and eventually at maturity, it will deplete completely. Okay, these are the two reasons, the first two reasons why sometimes you see the price of the warrant does not move according to the movement price of the mother share. Okay, the third one is because of the implied volatility. We've already talked about implied volatility earlier. And then this is one of the reasons also why you see the difference in the movement of the underlying share price as compared to the movement of the warrant. As you can see here in this example in the graph, where the decoupling happened, it's because of the high demand of the warrant and the warrant price continuing to go up even when the price of the mother share goes down. As you can see here, the mother share being on the red, being the red color line, and the core warrant price being the blue color line. And here on the second area, the warrant price goes down when the demand of the warrant goes down, even when the mother share price moves sideways. All right. And here on the third area over here, the warrant finally tracks the price of the mother share once the implied volatility stabilizes. Okay, so this is how the implied volatility, if it goes up too much, and it will affect the relationship between the mother share and the warrant itself. And it's important to know that the warrant market is technically independent of the share market. The mother share, the market for the mother share and the market for the warrant is a completely two different market. Each of these have their own supply and demand as well. This is what you need to be aware of when you're buying structured warrants. If that decoupling happens, the demand of the warrant could be too much and it will not reflect the movement of the underlying share price. Okay. All right, now we move on to the frequently asked question number 2. Should I go for warrants with the highest traded volume or should I go for warrants with the highest traded volume? And thus low traded volume means low liquidity. Okay, this is sometimes some of the questions that we receive from investors. They are saying they are looking at the level of the warrant is being traded in the market. warrants are being bought and sold in the market at a very constant level, and there's a lot of trading going on in the market. And they're wondering if these are the warrants that they should be buying into, as compared to looking at the liquidity of the warrant. And they are wondering, sometimes they are confused. There's some confusion between the volume traded of the warrant as compared to the liquidity of the warrant itself. Liquidity is provided by the market maker, and in this case, it's Maybank, and you have about 6 market makers here in Malaysia, market maker and issuer. So let's take a look at the example over here. You can see in this table, you have 3 warrants for comparison. You have warrant A, warrant B, and warrant C. Each of these have different bid volume, as you can see over here, bid volume. And warrant A would be the easiest to get out of, given the high available bid value. Bid value. You can see bid value over here and bid volume over here. Because this is a lot higher than the rest, you can see here, this means warrant A is the one that have the better liquidity among the 3 warrants that we're seeing here, not because of the traded volume. You can see, even though the traded volume is very high for warrant C, and also very high for warrant B, but the bid value and the bid volume over here is a lot less than warrant A. A lot less than warrant A. If you buy warrant B, and because of liquidity, which means people buying and selling in the market is very low, the number of people buying and selling in the market is very low, it will be very hard for you to get out at a reasonable price. This is the importance of liquidity. If you have a lot of buyer and seller in the market, which is also partially provided by the market maker, the issuer, if you have a high level of this, it will be easier for you to get in and get out of that particular warrant position. If you have a lower liquidity, it will be harder for you to get in or get out. All right, this is the idea behind the difference of traded volume and also the level of liquidity for each of the warrant that you can see in the market. Okay, these are all the concepts and ideas that I have to share with you guys today in our intermediate session. All right, I hope you guys enjoy our session today. Thank you for tuning in. We'll see you guys again soon in the future. Thank you. Have a good day.